Chapter 10: The Short Squeeze. The appeal of selling short is easy to understand because stocks can drop much faster than they rise. There are unique risks involved when you sell a stock short. The biggest risk to a short seller is that the stock price rises instead of drops. A rising price in a heavily shorted stock can lead to dramatic upward price movement, as losses mount in the accounts of those who are short. The short sellers magnify the upward price movement as they buy the stock to try to minimize their losses. This can lead to dramatic upside price moves where trend traders can profit. This momentum creates a double demand, new long purchases and shorts covering, for a stock when there is not much supply offered. Additionally, supply is often tight for a stock in a strong uptrend as holders want to hold their profitable position. When the stock rises rapidly, the shorts lose money, and as they try to cover their bearish bets, they compete for supply from new longs. Because there is extra competition to buy the stock, the shorts feel pressure from mounting losses, and they become squeezed. Before we explore the dynamics of a short squeeze, let's cover some terminology and learn how to interpret short sale data. Short interest refers to the number of shares sold short and not covered bought back. Because these shares are still open short positions, they represent a source of future demand. The short sellers either buy the stock at lower prices to lock in gains, or they buy at higher prices to minimize losses. It is useful to know when a stock is sold short. Exchanges mandate that brokerage firms accurately keep and report the numbers of shares sold short and not yet covered. Twice each month, the firms tally all short sales and send the data to the various exchanges. The exchanges then combine the firm's data and publicly disseminate the information. FINRA releases the number of shares sold short twice per month. The number reported to the public is never the real-time number. In fact, it is a minimum of 2 weeks old. For instance, the total number of shares for stocks as of January 15th, in the table below, is reported to FINRA by January 20th and is released as public information on January 27th. That means the stocks continued to trade for a full 7 business days, or longer, before FINRA releases the information to the public. As we will see, the information is still useful to determine the trend of short sales and the price levels where the short sellers are involved. Short interest ratio / days to cover. The short interest ratio, SIR, or days to cover, is the number of shares sold short interest, for an individual stock, divided by its average daily trading volume over the previous 2 weeks. We interpret the SIR as the number of days it would theoretically take to cover, buy back, the shares that were sold short based on the average daily volume. I use the term, theoretically, because the shorts are not the only participants in the market. Table 10.2 shows the number of shares sold short was 13,918,435. At the time of the report, the average daily volume for this stock was 2,047,326. When we divide the short interest by the average daily volume, we get the number known as days to cover, DTC. We also refer to this as short interest ratio, SIR. In this example, the SIR equals 6.8. This means that if the shorts wanted to cover their position in full, it would take them just under 7 days if they were the only volume in the market. Of course, it would actually take a lot longer to buy all that stock back since other traders are also actively buying or selling the stock. The higher the SIR is, the more difficult it is to exit a short position and the greater the upward impact will be on price. I consider an SIR of 5 or greater to be significant enough to think a short squeeze could develop in the stock. The effective volume on SIR: if a stock had a short position of 4,800,000 shares and an average daily volume of 800,000, the SIR would be 6.0. This means it would take 6 full days of average daily volume for the short sellers to cover their bearish bets. If the same stock traded an average of 2.4 million shares per day, the short interest for the stock would be 2.0, or 2 days to repurchase. Using the same stock, but with an average daily volume of just 200,000 shares, the SIR would then be 24, meaning it would take 24 days of buying to cover the positions. When their short position is at a loss and the stock has strong upward momentum, the short sellers feel trapped in their losing position. They know their buying will add to the upward momentum. From a trapped short standpoint, the lower the SIR, the better, as their buys will not have as large of an impact on price. When analyzing an opportunity to make a trade that takes advantage of a potential short squeeze candidate, a higher SIR is desirable, as it is more difficult for the trapped short sellers to cover their positions. The buys they need to make to cover their short positions have the potential to create significant upside momentum as more and more short sellers compete to close out their losing trades. You may see differences in the reported SIR from various data sources. The discrepancy occurs if the average daily volume used in the calculation is not from the last 2 weeks. Some data providers use a 50-day average of volume rather than the average of the last 2 weeks. It is important to note that a large outstanding short position or short interest ratio by itself is not a reason to buy a stock in anticipation of a short squeeze. It is an excellent gauge of potential demand for a stock, which should be a part of every trader's arsenal. Short sellers are often correct. Short sellers with large positions against a stock are typically sophisticated speculators who have done extensive research on their targeted company. They are often correct, and they make large profits as the stock declines. There are also those short sellers who have the right idea based on their fundamental analysis, but the timing of their short sales is off. That can lead to their positions being squeezed. When short trades are correct about a trend, they will add to their positions, as seen in Chart 10.3. The stock in Chart 10.3 was in a steady downtrend, red arrow, and the short interest continued to rise, green arrow, as the prices fell. The short sellers were emboldened by the lower prices and added to their bearish bets as the stock price dropped. Short interest trend. When we look at the changes in SIR during reporting periods, we can spot the trend of the short sellers and then recognize the value of the information. In Table 10. For you can see that in late May there were only 225,000 shares sold short in the stock, 1, but it had jumped to 13.9 million shares by January 15, 2. That means the shorts added 13.7 million shares to their short position in 6 months. The average daily volume increased from 746,000 to 2 million, and the SIR climbed from less than 1 to 6.8 days. The information in this table is used in Chart 10.5. Now we know when the short sellers became more aggressive. Next, we want to know at what price they shorted. If they shorted at prices higher than the current price, they would not feel pressure to buy back because they are in a profitable position. When the average short position is initiated at lower prices than the current price, the short sellers are in a losing position, which makes them vulnerable to a squeeze. Chart 10.5 below shows how rising prices motivates short sellers to cover their positions. As we see in Chart 10.5, the short position increased from 2.0 million shares to 13.9 million shares from the end of September to January 15. The AVWAP from September 25 to January 15 was about $13.01. We can assume this is the approximate price most of the short positions were initiated. When the stock broke past the range A, it closed near $20 that day. That means the average short at that point was down approximately $7 per share. That's more than a 50% loss overnight. Notice how the number of shares in the short position dropped by 6.2 million shares, from 13.9 million, down to 7.7 million shares in the next month. This drop is clear evidence that the short sellers took some large losses and they remained in a vulnerable position on the balance of the trade as the stock made higher highs and higher lows after that gap higher. Market psychology. When do short squeezes occur? A short squeeze develops when those who sold the stock short, with the expectation it would continue to decline in price, change their minds about their trades and attempt to cover their positions before the stock advances and large losses accumulate. The occurrence of a rapidly rising stock price with a large short interest is known as a short squeeze. The short's buys become part of the market impact cost. as their buys negatively affect the position they are in. There are several groups of participants who play a part when a stock gets squeezed: fearful buyers, forced buy-ins, margin calls, target short squeezes, and stock loan calls are some of the ones we explore below. Fearful buyers: if you have ever been short in a stock that continues higher against your position, you understand the fear that higher prices elicit. To eliminate the mounting losses and the emotional trauma of holding a big loser, short buyers may panic with their purchases. These purchases cause the stock to advance at a rapid pace as the pressure of holding a losing position mounts on the short seller, and the short seller gets squeezed. The primary motivation to cover a bearish position, as the stock rises, is the fear of unlimited losses. When you buy a stock at $30 per share, your maximum loss potential is $30 per share. When you sell a stock short at $30, the potential for loss is, in theory, unlimited. The stock may rise to $60, a 100% loss, or it could climb to higher levels resulting in losses of greater than 100%. It is the fear of such an advance that can make for an explosive upside moves in a heavily shorted stock. In Chart 10.6 we see a clear example of shorts covering their position as the stock rises. Chart 10.6 illustrates what a short squeeze should look like. The stock broke past resistance, A, and then settled in for a few days. Once the stock made it past the envelope, B, from A, the buyers regained control of the trend. The short interest below the price action shows how the upward momentum motivated short sellers to reduce their position from 16.9 million to 11.39 million shares. Short squeezes can occur for many reasons, including news events that change investor perception of the worth of a company. A short squeeze can also develop as long holders of the stock attempt to push the price higher in an attempt to tap into the emotional buying that trapped short sellers often provide. If buyers are in control of the stock, it is in a stage 2 uptrend, they know short sellers are vulnerable. So long holders will often buy extra shares as the stock rises, with the hope the buyers can create enough fear in the short sellers so they buy back their position, resulting in the price moving higher. This can be like pouring gasoline on a fire, it only serves to make it burn hotter and stronger. Forced buy-ins: sometimes short sellers find themselves in a position of being forced by their brokerage firm to purchase the shares they had sold short, to cover their short positions. There are two reasons for forced buy-ins: margin calls and targeted short squeezes. Margin calls: when losses in a short position have gone so far against a customer that the equity levels in their account fall below exchange requirements, the brokerage firm is required by regulatory bodies, the SEC, NASD, as well as others, to demand the customer either to deposit more margin money into their account or buy the shares to close the short position. If the customer does not deposit the additional money, the brokerage will buy the shares to close out the short position and get the customer's account in compliance. Another reason for a forced buy-in of a short position comes when the shares shorted are no longer available to be borrowed against. When long holders of the stock, who have allowed shares to be borrowed for a short position, sell their long position, the short sellers who borrowed those shares will have an illegal, naked, short position. If this occurs, it is the responsibility of the brokerage firm to demand that short sellers either find other shares to borrow, or force customers to buy the stock. If the short seller cannot locate other shares to borrow, the short seller is required by securities regulations to purchase shares, or the brokerage firm will do it for them. The forced buy-ins are not handled with care. The brokerage firm is only concerned with making the buys before the close of business, before the risk is assumed by the firm. This can lead to dramatic upside movement in a heavily shorted stock. Targeted short squeezes: there is a more sinister way the short sellers can be squeezed, called a forced buy-in. When large, long holders wish to inflict maximum damage on short sellers, they will allow their stock to be borrowed until a time where the buyers have taken control of the trend. If an institution that is in a long position of a stock, let's say 1 million shares, suddenly demands that the shares they loaned out be delivered back to that firm, the short sellers who borrowed the shares are stuck looking for new shares to borrow. If the short seller cannot locate new shares to borrow, they must purchase the shares they are short. This is effective to place pressure on shorts because of its cold-hearted implementation. In effect, the long holders set the shorts up to be squeezed. No one said Wall Street was a nice place. Stock loan calls: when you purchase shares, you can request that the company issue an actual stock certificate, but this is rare. Most investors purchase stocks in street name, which means that the brokerage firm holds the shares as a convenience to the customer. A source of revenue for brokerage firms is to loan customers shares to be shorted. Depending upon how the investor, you, purchase shares and set up your brokerage account, you can either allow or not allow a brokerage to loan out your shares to short sellers. If your shares are in a cash account, the brokerage cannot loan your shares. If your shares are in a margin account, and therefore with an hypothecation agreement, it allows the brokerage firm to hypothecate, lend out, these shares to other customers who may want to establish a short position. The brokerage will charge customers fees to borrow stock for short positions. A way to prevent your long positions from being lent out is to enter a good until cancelled GTC sell order on the stocks at a price you believe has little chance of being transacted. For instance, if your stock is trading at $30, you enter a GTC sell order at $200. Because of the pending order to liquidate your long position at $200, the brokerage firm cannot lend out the shares in your account. Two types of short squeezes people often call any short-term stock bounce in a downtrend. A short squeeze. Most quick rallies in a downtrend include short sellers covering their positions during, and in part, causing the rise. Not all short squeezes lead to a continued upside price increase. Below we examine two different types of short squeezes: the short-term knee-jerk squeeze and the longer-term structural short squeeze. Knee-jerk short squeeze: this squeeze occurs in a longer-term downtrend with a large short position. When a stock in an established stage 4 decline is accompanied by a large short position, short sellers are in control of the trend. Their accumulated profits make short sellers less likely to panic and cover at the first signs of a bounce. When prices are in a stage 4 decline, short sellers can dig their heels in and stay short until their bearish opinion changes, or, in the most severe down market, the stock becomes delisted in a bankruptcy. Still, some short sellers will panic and cover their position after even a small bounce. Chart 10.7 shows a knee-jerk short squeeze. Notice how, after the large gap down in November, short sellers covered some of their shares, which you can see in the declining short interest. As the stock continued lower over the next few months, short sellers became emboldened and nearly doubled their short position, green arrow. While many participants try to buy the dip as a long position, short sellers know there is no such thing as down too much. Therefore, they continue to hold their short position. Stage 4 decline stocks can experience quick and large rallies, but those short-term bursts typically fail as longer-term selling pressure is too strong to overcome. Psychology: trading against the trend. Stocks in a downtrend will attract momentum short sellers, who pile on extra shares of short stock after the short-term rallies. You may be tempted to buy the short-term rallies because they can result in quick trading gains. However, when the longer time frame is lower, long purchases are very risky trades. These short-term bounces are best left to the most risk-tolerant traders who specialize in the shortest time frames. The best course of action is to stay with the primary trend rather than fight them. Structural short squeeze: a second short squeeze is what I call a structural short squeeze. It occurs when a stock in an established stage 2 uptrend has a large short position that is out of the money. When we combine the price data along with the short interest trend of the short sellers, we can determine the approximate price level where the short positions were initiated. We use this information to determine the pain point where the short sellers, in the aggregate, are in a losing position. Once the average short seller is losing money, the stock is vulnerable to a squeeze and a subsequent increase in price. If most short positions were initiated at lower levels, the growing losses in a rising stock motivate short sellers to reconsider their positions and purchase the stock. When they cover their shorts, additional demand fuels the market, which adds further pressure to the average short seller. This type of squeeze setup, chart 10.8, can lead to substantial moves higher. This is based on the large number of short sellers who are wrong about the stock's price decline. The stock in chart 10.8 shows an initial advance from A to B. During that rally from $32 to $52, the short sellers remained stubborn about their view of the stock, as shown by little change in the short position, blue arrow. After the rally began to pull back, we anchor AVWAP to B. We can see the short sellers remained complacent, and even added a few shares to their bearish bets, to 11.7 million short shares. It wasn't until C, at $45 per share, when the stock crossed back above the AVWAP from the prior peak, B, that we knew for sure the buyers were back in control. At D, short sellers began to cover their positions, red arrow. Over the next few months, the stock rallied from $45 up to $69 per share, and the shorts covered 5.7 million shares. The stock still had 6 million shares of exposure with the stock at all-time highs. I wouldn't want that position. The stock in chart 10.9 shows when the shorts remained stubborn. Focus on B, where the buyers clearly took control of the stock. We knew for certain the buyers were in control from that peak, B, where it crossed above the AVWAP anchored from the high, A. Short sellers who increased their position from 3.9 million to 12.3 million shares that are near B, were in trouble because the stock was above that AVWAP. The interesting part is that the short position was at the highest level, 13.7 million shares, while the stock broke to an all-time high, after C. The AVWAP, green, from the last higher low, C, was rising under the stock as it traded in a tight range. With buyers clearly in control and short sellers in a large losing position, this is the type of stock you want to identify as a structural short squeeze candidate. Here are some general points to help you determine the stocks that may become structural squeeze candidates. 1. Uptrend on the daily timeframe. At a minimum, the stock must be above the rising 50-day moving average. Stocks that are near all-time highs are best because there is no real motivated source of supply from holders looking to get out at break-even, and all of the longs are in a winning position. If the stock is in a downtrend, it is not a good squeeze candidate, as short sellers are in control and have no reason for aggressive purchases. 2. Absence of any hedging vehicles. Some common ways for short sellers to hedge bearish bets are with options, a different class of common stock, warrants, convertibles, preferred stock, or any other hedge products. If there is an inability to hedge against a short exposure, it will leave the short seller in a more vulnerable position. 3. Short interest should be high relative to average volume. The higher the SIR, the greater the difficulty short sellers will have in purchasing their shares. 4. Level of potential squeeze. Check to see the approximate level that most shorts were initiated. We can approximate this with the AVWAP. When the stock rises above this level, the average short seller is losing money. That makes the shorts exposed to a squeeze. Stocks with double sources of demand, longs and shorts, and tight supply, especially if the stock is at or near an all-time high, can lead to excellent upside trade opportunities. Short sellers are usually savvy speculators. However, like any group of market participants, they aren't always right. When shorts are wrong about the direction of a stock, their move to cover can lead to some excellent trend opportunities for traders who can recognize the squeeze situation develop.